For more on what's next to the markets, let's bring in Kristen Bitterly. She's Citi Global Wealth Management's head of North America Investments. Kristen, great to have you with us. We were just talking about the mixed signals that we're getting about the consumer when it comes to the high-end consumer versus the low-end consumer. I'm wondering where you stand on that and how that educates your view of what the risk reward is in the markets right now with the S&P, at 4,000 roughly.
Yeah, you really have to look through the data because I think the headline data can actually be pretty confusing. So, for example, one of the data points that came out recently was around retail sales. And at first glance, it looked really strong at plus 3%. But there are a lot of adjustments that come in, especially in that January data, to factor in seasonal adjustments. So the unadjusted data was a decline of 16%. And so in reality, what we're paying attention to are things that are changing the consumer behavior, changing their spending patterns, because that's 65%, 70% of GDP. And so credit card balances, we're keeping a close eye on credit card balances, which have already eclipsed pre-pandemic highs. Consumers have already spent through that stimulus, and now they're actually spending based on credit. And so their behavior, we're starting to see these changes in terms of trading down, whether it's in the retailers spending on durable goods as opposed to discretionary goods. And so these are all things that are going to affect numerous parts of the economy and definitely corporate earnings.
It's Karen. Thanks for being on. Let me ask you, you have a great insight into the consumer, given that, you see so many, I don't know how many billions of transactions, but for the higher end, the luxury good market, that seems to be completely impervious to whatever economic cycle we may be in. Do you think that will continue? Do you think that divergence from the consumer who may be getting a little weaker?
I mean, it is interesting because you have started to see in the luxury part of the market, or you could say within ultra high net worth, those are they're not as sensitive to inflationary pressures as in other parts of the consumer. So where you're starting to first see the cracks is obviously in the most heavily impacted from an inflation standpoint. But I think some of the interesting things happening from retailers are quite curious in terms of that trade down effect, and almost that you're seeing some new consumers. We saw this recently, actually last quarter from Walmart, that they were getting new consumers, new customers into their overall base. And so I think those spending patterns, it's not just at one part of the economy, it's starting to trickle through in all areas.
Kristen, what are your thoughts on unemployment and just the job market in general? I mean, it's incredible how tight the labor market is, how sticky this unemployment rate is, around 3.5%. This is just my opinion. I'm pretty convinced if the Fed could wave their magic wand, they'd want this thing to trend up to 5% and let that do their job for them. It's just not happening. You're seeing some things, though, I think, in the housing sector that interests you on that front.
Yeah, so I think what we have to do is break down leading indicators versus lagging indicators when it comes to the overall health of the economy and what could actually lead to then some declines in the employment rate. And so we've been following housing very closely. Leading indicators, so obviously the famous ones, the inverted yield curve in terms of signaling a recession, but also new housing starts. So in the housing market, what we saw in 2022 was a big decline in new home sales, in resales of existing homes, 30, 40%. New housing starts, though, just started to decline at the end of last year. When we look at that into Q1 of this year, we're seeing that continued decline. And that's a part of the market. We talk a lot about the tech layoffs, but technology only represents around 2.5% to 3% of the overall existing labor force, where something like construction is substantially more. So that's something that from one day to the next, you could actually see a couple of 100,000 jobs impacted as opposed to what we're seeing presently. And that definitely would have an impact on the overall consumer spending backdrop.
So, Kristen, we're going to end it with this question. If you had fresh money to put to work right now in the markets, would you put it in a one-year T-bill or S&P 500?
I have a hedge to this. I would put it in T-bills at this moment. However, I would also hedge out that reinvestment risk, and I would diversify across fixed income, an area that we love in the market right now, preferreds, both from the investment grade issuers. You're getting mid to high single digit yields on a tax equivalent basis. You're actually getting high single digit yields. So managing some of that reinvestment risk and duration risk and complementing that, especially if you're sitting in cash, make sure that you're getting the best interest. And even 6-month T-bills are a pretty attractive yield at around 4.90.
Yep. Kristen, thanks. Kristen Bitterly of Citi, and Karen
Yes.
You bought treasuries yourself.
I did.
It seems like all the rage these days.
It is
all the cool
rage.
kids are
I
buying
know. We
T-bills.
were just talking about our little treasury purchases, and I never made one until last year. Now I've made 2.
Yeah. Julie?
Yeah, it's hard to argue for, being bulled up about treasuries when, all we do is equities. The reinvestment risk is not to be overlooked. I think being able to time the market is not something that I feel most people can do very well. And so I think you still want to have some level of investment in equity markets, especially with unemployment the way it is.
All right, so every once in a while, I like to quote our friend Rosie. Remember David Rosenberg, Research? He had a tweet this morning. I love this tweet. A guy and I had already, I think we read it back to each other like 4 or 5 times today. The no landing narrative is the biggest hoax Wall Street economists have peddled since the decoupling. Remember that global decoupling 2008 thing? Okay. Follow the leading indicators. And I mentioned that because that's what you just said. Follow the leading indicators. And to me, I just think that's really important. Like these really silly narratives they bubble up a little bit, right? And some of these economists are so disconnected from markets, right? And so, in my opinion, I mean, a lot of them are academics, that sort of thing. And so, what I love about a guy like Rosie, like he's been in the pits, in the trading pits. He's also an economist. He also likes to pick apart what I think sometimes is the universal bullish sort of consensus here. And so, follow leading indicators. She just said it too.
The other night, didn't you yourself just say that no landing was the stupidest thing you've ever heard?
Yeah.
Something to that effect. No surprise that you like that.
So, Rosie, fan of the show.
What about like a Carrie Strug landing?
Yeah, she's great.
Just
You know my thoughts
stick it
about
with the broken
Carrie.
ankle. What?
Did she really have, or was it theater at the highest level? Now I know Carrie Strug is a huge fan of CNBC's Fast Money, and I'll wave the flag like everybody else. But that was a little fugazi, if you ask me my opinion.
I don't know. A lot of Carrie Strug fans are going to be writing in right now.
I'll do a back handspring right now.
When we come back.